Hey class, I just wanted to go over with you a couple of the harder problems for the first week. Um, this is not something I'll do for all your problems, but just because it's the first week, I wanted to kind of help you get started and kind of explain some things that'll carry forward and future problems. This week you have three problems that are due. You have problem from chapter one. That would be problem 1-13. You have problem 2-1 and problem 2-2. And you can see 2-1 and 2-2 are the same company, just different ownership percentages. So they just changed how much was purchased. First of all, let's look at the template that you're going to need. So this template was provided for you, in the assignment, and you can see in the first part, it just gives you a breakdown. I did this just so you could see, what was if you have so much time to do the homework, then it's nice to know which problems are weighted more heavily, so you can manage your time more wisely. All right, so I'm not going to really go through problem 1-13, which is a little bit more straightforward. The consolidations of problem 2-1 and 2-2. First things first. When you look at this problem, these top boxes here, they're in blue, and in the future, they're not going to be in blue in the templates perhaps, but it's the value analysis, the D&D schedule, and then what you got. These are really just support schedules. Here's what would be required if you were doing this for uh, for a company. You would be required to fill out this worksheet. So it's really important that that's what you do. So this part is what I'm going to focus on. However, these supporting schedules are really useful. Just because I don't necessarily you know, count off if they're not done doesn't mean that I don't think they're useful. It's just, uh, you know, I wanted to grade you on what would be required in a real job, and these support schedules, would be something that you would probably do on your own, not necessarily something that you would present to anybody, like your boss. First of all right, let's go ahead. The ownership interest is whatever it is. It's this in problem 2-1 is 100%. So they're just trying to tell you how to put it in a percentage number, whatever. That's fine. Then how do they buy it? So this is important that you look at this. So we bought 100%, and the parent company is issuing shares, and here's the market value and the par value, and then they also paid some acquisition costs. Then they have the balance sheets for both the parent and the sub, and then they have the subsidiaries' fair market value. And notice one of them, I believe it's land. Yeah, land actually has a decrease in fair market value. So that's just a little bit of a twist there. Now you'll notice a lot of times I'll put little check figures for you. That's just to kind of help you. Don't get so focused on check figures that you're kind of, like the expression goes, the tail wagging the dog. You're trying to get everything to work onto the check figure. Follow the process. Follow the process of consolidation, and then the check figures, just think of them as maybe a little extra information that you wouldn't normally have in a real world situation to kind of see if you were on the right track. But if you don't hit the check figures exactly, that doesn't mean I'm going to take off you like you got the whole thing wrong. It just means there's something in the process that you overlooked or are a little off on. So this schedule here is just the balance sheet. It's the book value, the market value, and then in this corner here, I'll just give you another check figure. It's 460,000. That is the the net value when you take the market value of the assets minus the market value of the liability. No big deal, right? There's no goodwill yet, so you don't have to worry about that at this point. This just basically comes straight from the problem. Now we purchased 100% with this problem. So if we're looking back here at the assets, you just take this information, right, and then you take the market value. And on the value analysis, what you're doing is you're looking at, what was paid for the assets minus the fair market value of the assets, and the rest will be goodwill. And so there's a little check figure there to show you what your goodwill should be. That's an important number, so that's why I wanted to allow you to have it. Also, the NCI is the non-controlling interest. Remember that this is 100%, so this is going to be left blank. It's not needed for this problem. Then we get the D&D schedule, right? And with this, this means what we're looking for is taking the extra value that we paid, and then splitting it up between all of the assets that are, and turning them into fair market value, and then the rest will be goodwill. Okay, so the parent company, so the price that we have here is what we, this is what we paid for on the top line. You can see this in the chapter. And then we had the equity here, and then the price minus the equity. Remember, equity is like net value because you get your equity by taking your assets minus your liability. So take the company, you take the equity, and then the difference is the goodwill. I said goodwill, but it's the goodwill after you adjust all your assets up. So you get your price paid over the equity, and then distribute to the different assets, and then the rest is the goodwill. So hopefully that kind of explains that. This is where you really have to do the work. Right now, this number here is a given number for what your totals should be in your debits and credits. Make sure you use your keys here as to show, the journal entry is, EL would be one of the keys, and then, D, and then D1, etc. And you can make those text if you want. I just had them as lowercase. But what you're going to do is you're going to have your investment, right? So you want to get rid of your investment. You want to get rid of the stocks and other equity in the sub. And then you want to distribute, the rest of the investment is going to be distributed between the assets and being marked to market value. One of the assets is going to actually have to be a credit because it's reduced. And then that's it, right? Then you have everything you need. So then you just take these over. Now notice I have your amounts already in from your balance sheet. And something to point out, for the role in the parent company in the book, it shows you as $50,000 for your other current assets. But remember, you paid $40,000 in cash, and that also goes towards, that reduces your retained earnings as part of the expenses. So that's why, it's $40,000 different in your retained earnings and in your cash because of that expense you had for the cost to the acquisition cost. Then after that, you just kind of add these over with your eliminations. Make sure all of these are numbers so you can sum them up. You can actually put a summation here instead of having a hard-coded number. I want to see that you're using the benefits of Excel. And then once you have your journal entries in here, you just bring them down to here and show them here. I want to see that because that would be important too. And your debits and your credits should equal. Your debits and credits, but they're going to be positive and negative. So at the end, this total amount should, if you added all your positive and negatives, debits and credits, it should zero out.